Thank you so much, everyone. It's really great that you can join us. Today's webinar is all about the second consultation package on TPR's DB funding code, building on what came before in 2020 and from DWP's draft scheme of funding regulations. The Pensions Regulator actively wants to engage with you, our membership, on this very important piece of work to better understand how the industry's thinking is evolving as we're all going through the consultation with a fine-tooth comb. I know many of you, many of us rather, are still intaking and digesting everything, but hopefully today's conversation will shed additional color to our collective reading of the draft code. We have two guests today from TPR, key members of the funding code team, who will give an overview of how the different elements of the DB funding code package and DWP scheme funding regulations will integrate and work together before they're finalized. First, we'll have Andrew Dodd, who is a lead actuary who has worked at TPR for 10 years on a wide range of engagements and cases. He is a leading member of the team, which drafted both TPR's consultations on its new DB funding code of practice and helped DWP with their draft funding and investment strategy regs. Then we'll have Katrina Martland, who is a lead business analyst at TPR, works closely with TPR supervision teams, providing covenant advice in relation to events, rapid response interventions, and one-to-one relationship supervision. Over the past 12 months, she's been involved in the drafting of the covenant sections of the new DB funding code of practice and updating the covenant guidance that will accompany the code in due course. She's a chartered accountant and prior to TPR, worked for over 9 years as a covenant advisor to trustees and corporates at one of the big 4 consultancy firms. So before I turn it over to them, I just wanted to note that the session was originally set for 45 minutes, but seeing what a big audience that we have here today for the session, Andrew and Katrina have kindly agreed to stay for an additional 15 minutes to round out the hour so we can grab as many of your questions as possible. So I hope the short bios that we've just given you gives you an understanding of their expertise, and you can see as well we're in good hands for the conversation over the next hour. So Andrew, Katrina, over to you, please.
Thank you, Tiffany, and thank you for inviting us to speak to the PLSA members today. But before we start, I just want to give a bit of context. So I first got involved in the DB funding code team at TPR just after the white paper was published in March 2018. So that is almost 5 years now since first got involved in looking at what the code might look like. And it's fair to say we've seen a lot of events happen during that time. We had an election, we had Parliament dealing with Brexit, we had a global pandemic. And just as we thought we were coming out of that, of course, we've had war in Europe, energy crisis, along with 3 changes in Prime Minister, and quite a lot of volatility we saw in markets last year. And at the same time, it's fair to say that DWP have had other priorities they wanted to take forward, climate change, CDC, dashboards, value for money. So it's absolutely right that it's taken longer than planned for us to get where we are. But I just want to say we are in the final straight now. We are almost there. We have got out our second consultation on the code, and if everything goes to plan, the new code and regulations and code should be enforced by the end of the year. So let's look at what we're going to talk about today. So firstly, Katrina is going to give you a bit of an introduction, talk about the timeline, what's happened so far, what needs to happen from here, and the suite of documents which we published in December that we're consulting on. Then we'll look at the first aspect of the new regime, long-term planning, and the new requirement for trustees to have a funding and investment strategy. We'll talk about what we think low dependency by significant maturity means, how trustees should assess the employer covenant, which Katrina will lead on, and then look at how risk needs to be supportable during the journey plan to achieve that long-term target based on the strength of the employer. And then we'll look at how it would apply to valuations that schemes would do. Firstly, the technical provisions, which need to reflect the scheme's funding and investment strategy. And then if there's a deficit in the scheme, a recovery plan, which needs to be based on reasonable affordability. And then finally, we'll look at our regulatory approach, the twin track approach, fast track and bespoke, and talk a bit more about what fast track looks like. So I will now pass over to Katrina.
Fantastic. Thank you very much, Andrew, and thank you again for having us here today. So this slide is really setting out a timetable to show how we've got to where we are today. So as you can see, and as Andrew's already mentioned, back in 2018, DWP released its white paper, which concluded that there was no systemic issues with DB funding, but there was room for improvement. As a consequence, we responded to that in March 2020 with our first DB funding consultation, which set forward our proposal for a clearer and more enforceable funding framework. In this, we set out our initial thoughts around the twin track valuation approach. We also put forward our key principles that trustees would have to stand by, and also set out how this could work in practice. We had 127 responses to the consultation, broadly showing their support for the proposal, but obviously, as always, the devil is in the detail. So since that date, in February 21, the Pension Scheme Act 21 received royal assent, and then DWP also consulted on its regulations last summer. It's these regulations that form the legal underpin for the code that we're discussing today. We obviously released our draft code for consultation just before Christmas. Given the timetable, it has been very tight. You'll be aware that our code is reflecting the position that DW had for the draft regs that came out in the summer. So they don't reflect any changes to date that DWP may make following their consultation. However, we thought it would be useful to share with the market how we had interpreted those draft regulations. It's also important to note that we are working very closely with DWP over the code consultation period to make sure that the code and the regs are aligned. And we're also very keen to engage with the industry to get your feedback before it's finalised. So as Andrew mentioned, the timeline at the moment, we are still working towards having the funding code, or having the legislation and code take effect by the end of the year. The last thing I just want to highlight as well is these changes will be forward-looking. So it means that schemes with a valuation date on or after the commencement date will be the schemes that are affected. So no scheme prior to that will be affected by the new legislation. So if we just move on to the next slide, if that's right. Thank you very much. So this sets out the suite of documents that we provided as part of our second consultation package. So as I highlighted, obviously these came out just before Christmas. We have provided a 14-week consultation window. So the consultation will be coming to a close at the end of March. So the first document that we have provided is the draft DB funding code of practice. So this sets out the key principles and expectations for how trustees should be complying with legislation. And this document is really important for all trustees. The second document that we produced was the DB Funding Code of Practice consultation document. So in this document, we tried to provide explanation and narrative of how we got to the position we did in the code. It also sets out some further detail on what discussions we've had with DWP to date, and also the questions that we are asking you as part of our consultation process and would welcome your feedback on. The third document is the fast track consultation document. So within this document, we set out our twin track valuation approach. We also outline our proposed fast track parameters, which Andrew will go into more detail later on, and also set out our initial assessment of behaviour changes. It's worth highlighting here that obviously fast track and bespoke we don't refer to specifically within the code itself. However, it remains a key part of our funding regime. And then finally, the last document that you will have received is responses to our first consultation. So this really sets out the key themes that were coming out of that consultation and a summary of our responses to them. So without further ado, I'll pass you back to Andrew, who can go through the long-term planning section.
Thanks, Katrina. Yes, so we're going to look at three elements in the section. If we can move on to the next slide. So one of the key new requirements coming through from the regulations is for trustees to aim to have low dependency on their employer by the point of significant maturity. And there are different elements to this, three different elements. There's the investment allocation, the funding basis, and the time of significant maturity. And in the code, we've provided more explanation as to how we interpret trustees can comply with these regulations. For low dependency investment allocation, there are two aspects. Schemes need to broadly match their cash flows, and we've set out some more details as to what we think that means in practice. We do think that does allow schemes to invest some of their assets in growth, a modest proportion in growth, while still meeting that requirement. And also some more details around the level of hedging of interest rates and inflation that we'd expect trustees to achieve in that allocation. The second aspect is being highly resilient to short-term market movements. And there we've tried to be quite specific in terms of setting out a stress test, a minimum level of stress test, and the change in funding level, which we think schemes can have and still meet that requirement, 4.5% change in funding level and 1 in 6 stress. Moving on to the low dependency funding basis. So if we can go back a slide, funding basis, we specifically not put a maximum on the discount rate you can use for that, because we think it makes sense for schemes to determine that based on the low dependency investment allocation. However, we have provided guidance on the other assumptions that go up to make the funding basis, inflation, or with mortality, all the different demographic assumptions. And finally, significant maturity. So the regulations are quite specific in that maturity needs to be measured using duration of liabilities on a low dependency funding basis, and that it is one point in time specified in our code. So for the purposes of a code, we've said significant maturity is duration of 12 years. However, we do recognise the volatility we saw in gilt and bond yields, particularly in the autumn last year. And this meant that that point, based on 12 years duration, would have moved about years. I mean, it was moving years and days towards the end of September. So we recognise that makes it difficult for trustees to plan. So in the consultation document, we put some possible alternative ways that we could change that calculation of duration in order to make to remove that volatility, either smoothing or having fixed assumptions for the calculation. Okay, if we move on, please, back to Katrina.
Brilliant, thank you very much. So as you'll be aware, this is the first time that covenant has been explicitly recognised in DB funding legislation as a key underpin for supportable risk. So within the code, what we've tried to do is build upon the definition of covenant as set out in the regulations and provide clearer guidance to trustees of how they should be assessing covenant, in particular with reference to the employer's cash position, which we highlight being the free cash flow position of the employer as defined within the code, but also the employer's prospects. And again, within the code, we set out a number of factors that trustees should consider when looking at the prospects of the employer. And then finally, any contingent asset support, assuming this is legally enforceable and will provide sufficient support at the point in time it's required. The key here is that we aren't fundamentally changing anything about the definition of covenant or how trustees should be assessing covenant per se. In fact, what we're really looking to do is just embed what is currently being done by most trustees as good practice, but also to help develop the way that we expect trustees to be presenting covenant. To support the code, we are looking to update our covenant guidance to provide further detail on these 3 key pillars. That guidance will also provide more examples to try and bring this to life, but we'll also look to consolidate some of the previous publications that we've had, so that there's effectively one place that you can find all information around covenant. Within the code, we also introduced the terms visibility, reliability, and longevity. Some of you will be familiar with these terms, others maybe not so. So visibility is the visibility over an employer's forecasts. So this is likely to be a 1 to 3 year period. We also emphasize the importance of trustees scrutinizing those forecasts to ensure that they are reasonable. Reliability over available cash is the period in which trustees have reasonable certainty over the available cash to fund the scheme going forward. Again, we would expect that most schemes wouldn't be able to extend the reliability beyond the medium term, so really around the 6-year mark. However, we recognise that there may be certain industries who have significant transparency, for example, over their pipeline, that may be able to evidence that their reliability is longer than that. The reason why reliability is such a key point within the code is, as you'll be aware, it does underpin a lot of discussions around how trustees should be setting their journey plan, but also how they should be setting their recovery plan. So we'll talk about that in more detail later on. And then finally, covenant longevity. So this is the period in which trustees, or the maximum period in which trustees can assume that the covenant will be there or exist to support the scheme. So this is the period that we would expect for most schemes will be the longest. Again, we would expect this to be around the 10-year mark. All schemes are required to do a covenant assessment under legislation, but it's really important that people are taking a proportionate approach, and that is a theme that comes across both in the code and within the guidance. For example, if you're a very well-funded scheme, or if you're a very small scheme relative to a very large employer, less scrutiny may be needed when assessing their covenant compared to a scheme that might be poorly funded, for example, or very large relative to the size of their employer. And then finally, it will be necessary for trustees to evidence that the risk they are taking is supportable. However, it will no longer be sufficient just to provide us with a single covenant rating. So this could be CG1 to CG4, or strong to weak. The reason being is we have found those covenant ratings extremely subjective in the past. And therefore, it's important that trustees, to evidence that the risk they're taking is supportable, that they provide information on all 3 key pillars of covenant, so cash, prospects, and contingent assets. So I'll move you now on to Andrew, who's going to talk more about the journey plan.
Thanks, Katrina. Yeah, so talk about the journey plan. This is the journey plan from where a scheme is now to achieving low dependency by significant maturity. One of the new requirements in the regulations is that the funding and investment risk that scheme is taking must be supportable. And that's based on the strength of the covenant primarily, but also the maturity of the scheme. And in the code, we've explained that there are 3 periods that the schemes need to think about. They need to think about the period of covenant reliability, where they've got high degree of confidence that the employer can support the scheme and provide funding at the sort of level they can now. But the period after the covenant reliability, up until significant maturity, when there's less confidence about the ability of the employer to support the scheme to the same level. And then from significant maturity, there's a requirement to be at low dependency. And we put in a test for the minimum sort of stress or scenario, such stressful scenario test that we'd expect trustees to do to test the maximum supportable risk over that period of covenant reliability. So the chart we've got there is giving is out of the code, and it shows the maximum level of risk that we think trustees can take. Over that period of covenant reliability, they can take the sort of level of risk they are taking now. Then after that, we expect trustees to plan to reduce the level of risk and the reliance on the employer over that period down to significant maturity. But the key thing about this is a maximum level, and we think in practice, most trustees in most schemes will choose to take a level of risk which is somewhere below this maximum, appropriate for the circumstances of their scheme. Okay, so we've talked about long-term planning. If we can move on now to valuations, and we'll cover technical provisions first. So the key thing about technical provisions is they must reflect the scheme's funding and investment strategy. And what that means in practice is once you've worked out the funding investment strategy, how you intend to invest, how you intend to de-risk over time down to low dependency, that should then be reflected in your discount rates. And in this chart here, we've shown the highest discount rates that would be appropriate if schemes are taking that maximum level of risk. And as you can see, for the solid line, which is a closed scheme, it looks very similar to the chart we showed a moment ago, in that there's a period over the period of covenant reliability where the discount rates can be at their highest level, reflecting the maximum level of risk, and then declining afterwards down to the point of significant maturity, where the discount rates must be in line with the assumptions for low dependency. However, we have reflected that open schemes which have future accrual and possibly new members, they could have a longer period until they reach significant maturity. And we think it is reasonable for open schemes to allow for that future accrual and allowance for new members if they're still taking them in over the period of covenant reliability, where there's a high degree of confidence that the employer will be able to continue to provide DB benefits as it does now. And what that means is that extended period until significant maturity compared to an equivalent closed scheme means that the discount rates can be a bit higher overall, as shown by the dotted line here, and consequently the technical provisions can be a bit lower than they would be for an equivalent closed scheme. Along with talking about discount rates and expectations there, we have also provided guidance on the economic assumptions, so inflation, pension increases, and demographic assumptions, mortality, different member options, etc. Okay, so that's technical provisions. Now I'm going to ask Katrina to talk about recovery plans.
Brilliant, thank you very much. So within the code, we set out 3 areas that trustees should be considering when setting an appropriate recovery plan. The first is they need to consider their employer's reasonable affordability. The second is they need to consider whether to allow for post-valuation experience. And the third is whether they should allow for any further investment outperformance beyond what is already factored into their TP deficit. So for the purpose of this session, I'll really be focusing in on reasonable affordability, but we're happy to pick up any questions on the other 2 if helpful at the end of the session. So reasonable affordability shouldn't be a new concept. In fact, it is something that we've referred to in a number of our recent publications. In particular, we refer to it within our annual funding statement. However, within the code, what we have tried to do is be a little bit more prescriptive on how trustees should be assessing reasonable affordability to ensure consistency across schemes. So when determining reasonable affordability, again, there's another 3 steps that trustees need to do to assess reasonable affordability. The first is they need to work out what is their employer's available cash. So available cash is defined as the free cash flow of the employer plus any liquid assets within the balance sheet. The second step is they need to assess the reliability of available cash. So this links to the point I talked about earlier about understanding the period in which trustees have reasonable certainty over available cash to fund the scheme going forward. Normally, as I said, this will be a medium term kind of length in term, so up to about 6 years. The reason why it's important from a recovery plan perspective is it acts as a good proxy to understand what might be an appropriate recovery plan length. And then finally, once the trustees understand what is the pot of cash that is available, they then need to work out how much of that cash should be going to the scheme and how much can be spent on alternative uses of cash. Within the code, we set out 4 alternative uses of cash. The first is investment in sustainable growth. The second is covenant leakage, for example, dividends or share buybacks or potentially intercompany loan balances. The third is discretionary payments to other creditors. So a good example of this would be the early repayment of bank debt. And then the fourth are contributions to other DB schemes that the employer might support. Now, we appreciate that the latter isn't technically a discretionary payment, but we feel it's really important that trustees make sure that they are being treated fairly and equitably versus other schemes that the employer might support. So, as I said, within the code, we do set out 5 key principles that we expect trustees to consider when assessing whether or not these alternative uses of cash are reasonable. The first three principles really focus on when it's appropriate or reasonable to have covenant leakage or discretionary payments to other creditors. So where a scheme is less well funded or where it's becoming more mature, at that point in time, we would expect more cash to be coming to the scheme, and therefore covenant leakage and discretionary payments will appear more likely to be less reasonable. And likewise, when you have significant covenant leakage or discretionary payments that's actually resulting in the recovery plan extending beyond the point in which the trustees have reliability over available cash, it would be at that point again that we would be considering those payments to be potentially unreasonable. The fourth principle is focused really on the point that I've already mentioned around other DB schemes. So making sure that trustees understand what other commitments and other payments are being made to other DB schemes to ensure that the scheme is being treated equitably. And then finally, the last principle picks up on investment in sustainable growth. So as you can imagine, we do provide more flexibility to employers that are investing in sustainable growth than any of the other alternative uses of cash. It's the one, I think, thing that's very important with this principle, and the key really is that in order for trustees to get comfortable, we expect them to understand that there will be a significant benefit, or there will be a benefit from that investment in sustainable growth. If they're not able to have certainty that there will be benefit, it's at that point in time that we also recommend that they put in place some form of contingent asset protection. So that covers off recovery plans. So again, I'll pass you back to Andrew.
Thank you. To move on, yeah. So we're now going to look at the last aspect, our regulatory approach, and particularly fast track. We move on. Okay. So so part of our new regulatory approach is that there will be a twin track submission routes for schemes to demonstrate compliance with the legislation, fast track and bespoke. And the first thing to say is that all schemes will need to follow our code principles, whatever route they are taking. It's not the case that either route is better, and there's nothing that binds trustees to using, fast track at the same approach at different valuations. They can move between fast track and bespoke depending on the circumstances of the scheme and its employer. So let's look at fast track first. So fast track is a series of quantitative guidelines that we have set, a set of parameters based on level of technical provisions, investment risk, recovery plans, and also a requirement to meet the low dependency requirements by significant maturity that schemes can test themselves against in order to be sure that they meet our fast track requirements. And what fast track represents is a tolerated level of risk at which we are comfortable for schemes to come through in the door, and with less reporting and evidence required for us to be comfortable that they are not taking an inappropriate level of risk. And after due consideration, we've decided to go for one set of fast track parameters based on maturity only for technical provisions and investment risk, and one recovery plan length for schemes before significant maturity of 6 years, and three years for schemes who pass significant maturity. And if you look at our fast track consultation documents, we set out in some detail what the parameters are, how we've set them, how we've decided that is a level of risk we can tolerate. And I would encourage you to look at that if you're interested. The advantage of schemes taking the fast track route is they are unlikely to hear from us once they've submitted. But it's key to say that it is a tolerated level of risk, so it will not be appropriate for all schemes. In particular, if you've got a scheme with a very weak employer, fast track is likely to mean there's more risk than the employer can support, and the trustees should be thinking about taking steps to set a higher funding target and getting more cash into the scheme if possible than fast track. The other route is bespoke, and bespoke will allow a flexible approach for schemes based on their circumstances and their employer, so it is very scheme specific. One change we've made compared to our first consultation is we are no longer measuring the risk in fast track against, sorry, the risk in bespoke against fast track. We got a lot of feedback that that wouldn't work well in practice, and it would limit the how scheme specific valuations could be. So instead, it's a principle-based approach with all schemes having to follow our code principles, and we have tried to set some clear boundaries as to the maximum level of risk we think would be appropriate for a bespoke submission, which we've talked about today, particularly when it comes to the journey plan and the reliance on the employer. If schemes are taking more risk than fast track, then they will need to evidence how those risks are supportable in their statement of strategy. And similarly, if it's a recovery plan which doesn't meet the fast track parameter, they will need to evidence why that recovery plan is appropriate based on reasonable affordability, which Katrina talked about a few minutes ago. And if you submit to us using bespoke route, you might hear from us. You're more likely to hear from us, but it's still the case that we're going to take a proportionate approach. We're a risk-based regulator. So it's not definitely the case we're here for us. And in fact, we think because of the information we will get in the statement of strategy, many bespoke schemes, we will be able to satisfy ourselves without any further engagement that the approach they've taken is appropriate for the scheme. Okay, so final slide, because I do want to leave some time for questions. Just a summary of what we talked about. So we're consulting on our draft funding code and fast track proposals. The consultation ends on the 24th of March. I would encourage you to respond to that consultation with any thoughts you have. A key element of the new regime is for schemes to have a funding and investment strategy. Two elements to that: must achieve low dependency on the employer by the point of significant maturity, and the risk taken on that journey plan must be supportable based on the strength of the employer covenant, and secondly, the maturity of the scheme. Technical provisions must be set consistent with that funding and investment strategy. And when it comes to technical provisions, you can reflect the openness of the scheme in working out the discount rates, and hence the technical provisions, which means they can be a bit lower than they would be from the equivalent closed scheme. If you've got a deficit, reasonable affordability is a key driver of the appropriateness of the recovery plan. And in terms of our regulatory approach, there's a twin track approach, which sits outside the code, but is a way that we will filter schemes we want to engage with, or we're happy with their approach. The bespoke route, which provides a lot of flexibility for schemes, is just defined by the underlying legislation and our code principles. And the fast track, where schemes would need to meet a series of parameters. We've got one fast track line set by maturity, and one recovery plan length of 6 years for schemes before significant maturity. And finally, just to note that we will be continue to engage with the industry during the consultation period as we seek to finalise the code, and also work with DWP on an impact assessment for the regulations and code. And with that, we are at the end of our presentation. We're open for questions.
Thank you so much, Andrew and Katrina. We are right on schedule, so thank you for that. So we now have a very healthy 20 minutes, if we want it. We don't have to stay for the whole session to go through questions. Got lots of questions come through, so thank you so much to the audience for that. We will try and get through as many of your questions as possible. So I'm going to start us off, jump right in with a gentle one, and then we'll kind of ratchet up in terms of difficulty. So the very first one is an operational one. So Michael is asking, have we moved to saying code is enforced by end of year now rather than October? So that's tied into things that we've been hearing from membership too, just sort of concern about, are we giving ourselves enough time in between each process of the consultation to kind of make sure everything goes to plan, both on our member side and for TPR as well.
Yes, I'll take that one. So, well, the plan is still to aim for the 1st of October. Definitely, that's the date that DWP would like their regulations to come into force. And you may be aware that DWP, there's only certain dates of the year where regulations are typically allowed to come into force. So 1st of April or 1st of October or 6th of April. When it comes to our code, I mean, ideally we'd like the code to be enforced at the same day. In practice, it might be the code comes into force, a short period after the regulations, but still in time and it would only be when the code came into force that it would then apply to schemes doing evaluations of effective dates after that. And we are working very closely with DWP at the moment to resolve any issues we have and working towards the regulations and the code being enforced by the end of the year.
Okay, thank you so much. So we're still aiming for 1st of October and kind of wait to see what happens from there.
Yeah,
that makes perfect sense. Okay, so then moving on, a slightly harder question, but still kind of an operational side as well. So Katrina is asking, so this is coming from the position of being a well-funded or a small fund in comparison to the employer. There's some kind of chatter going around the industry saying that covenant advisors are saying that the code now requires an independent covenant assessment, but so along the themes of continuation from the last code and proportionality, will smaller schemes, well-funded schemes, be able to, can trustees continue to assess themselves this information from the employer, or will they be asked to take on more formal guidance, basically advice?
Yeah. So that was definitely not our intention to require schemes to have independent covenant advice at all. So our policy is very similar to what it currently stands. So we would recommend that a scheme takes independent covenant advice if they have a very complex covenant, potentially that the trustees themselves may not have the experience or knowledge to be able to assess covenant appropriately, or they may be have independence or objectivity issues. So those are the areas where we say it is a good idea that you should be seeking independent covenant advice. However, that is not compulsory. And actually, that's one of the reasons why we really wanted to update our covenant guidance and provide more detail for those schemes that are doing it themselves, so then they've got clarity on what they should be looking at. All I would say with that is it's just always important, regardless of what approach you go down, that you are kind of documenting why you are making decisions so that you can evidence that if you need to in the future.
Okay, fantastic. So documentation is key, basically evidence.
Absolutely.
Okay, so the next question is from Jennifer on open schemes. So this question is around how can a scheme open to new members set the point of significant maturity if new members are expected to continue replacing leavers?
Okay, yeah. So there's a couple of elements to this. I think the first thing to remember about open schemes is there is a difference between what trustees are funding for and how the investment strategy plays out in practice. And what we are proposing is that when it comes to funding, it makes sense for trustees to plan that future accrual will end at some point in the future. Covenant reliability seems to be the right sort of period, because after that you've got much less certainty that the employer will continue to provide, DB accrual. So plan for that accrual to end, and therefore to de-risk after that point, and then you can project forward and say, okay, well, at what point would I reach significant maturity, and reflect that in your funding. In practice, of course, when you come back to do an evaluation in 3 years' time, if the employer is still there as it was before, if you're still accruing, if the scheme is still open and still plan to keep it open, for the foreseeable future, there's then no reason to change the scheme's investment strategy. There's no reason to de-risk in practice. Furthermore, you can then reset the time at which you expect it to reach significant maturity. So there is a key difference between what we think it's appropriate for trustees to fund for, and then how that plays out in practice. The other thing I'd just say on that is we do appreciate that if it's a relatively immature scheme, open scheme as well, and that time to significant maturity is a long way away, we expect trustees to take a proportionate approach in thinking about what that long-term strategy would look like. It's much less important for them to think about the detail of exactly what the investment allocation would look like and all the aspects of funding compared to a scheme which is a few years away from reaching that point, a closed scheme a few years away.
Okay, great. Thank you. I'm sure some of our audience members who are representatives of open schemes might have follow-up questions, but I'll wait for them to ask them while I get on to some other part of the questions that have come through that have been voted for. So this one is coming from a very specific position as well. So Gordon is asking, so his circumstance is, so let's assume that the scheme is significantly mature and closed. Then let's assume trustees have discretion to increase member benefits. The scheme is well funded and the covenant is strong. So Gordon is asking, as a trustee, can he take more investment risk than the regulator seems to permit with the objective of improving benefits in a time of high inflation? It's a really good question. What do you guys think?
Yes, that's one for me again. So there is, okay, I think there's 2 points here. I think firstly, it's DWP have recognised that something that was missed in the regulations when thinking about low dependency investment allocation in particular was, well, what about if the scheme has a material surplus? Because that would seem to give the scheme more freedom to take a bit more investment risk because it's protected. So that's something that DWP are thinking about. If you look at the way we've set our parameters, particularly our fast track parameters, our fast track stress test used to test investment, we have allowed for funding level within that test. So we've recognised that if you've got a stronger funding level, actually that gives you scope to take some more risk. In terms of whether it's right to pay discretionary benefits, we do think that is a matter for the trustees and the employer of the scheme to agree on a scheme by scheme basis. We don't particularly have a strong view. What we are worried about is once you pay the discretionary benefits, you're not then reducing the security of the members' accrued benefits and new accrued benefits. But it would seem that if you do have a material surplus, that shouldn't be the case.
Okay, thank you. So I'm going to move us on to a slightly trickier question, but very timely. So someone in the audience is asking about the LDI crisis and how it fits into the code. And the main question here, and the person has very really great that they've articulated some of the key worries behind this question, is do you think the DB funding code will survive the committee's review, the DWP committee's reviews triggered by the LDI crisis? Appears to be accumulating evidence that trustees' reliance on market valuations and their assumptions has blinded them to real risks to the scheme and its capacity to pay benefits as they fall due. So in that question, there's some really good articulation on what some of the concerns are basically about. Rightfully, the regulations currently focus on matching scheme outflows and significant maturity with secure income streams, but with the LDI crisis, that's brought to light that might not actually play out in reality. So do either of you have any views on this?
Yeah, I do know one thing. I think so we do think that LDI, leverage LDI, some leverage LDI could have a role to play at the point that you reach significant maturity. And and actually we'll see, again, if you look at our fast track parameters, we have built in some leverage LDI into our investment strategy, which we've used to set the investment stress test. So we do think it can have a role to play. We think we don't know what the recommendations of the report are going to be, but we think if you think of anything, it's like there's likely to be a limit on the amount of leverage that you can have. And so again, you'll see we're not assuming highly leveraged LDI in terms of the strategies we might expect schemes to adopt but we do still think that, yeah, LGI can help, particularly with some of the interest rate and inflation risk for more mature schemes as they're approaching that significant maturity point.
Just a follow-up question that's come out just now, I think, as you were talking, so I just thought I'd pick it up now. So in light of the fallout from the mini budget, are you considering any restrictions or guidance on hedging? So for instance, the advisability of hedging long-term risks on a market-to-market basis and other common practices?
I think we're going to wait for what the recommendations are. It's certainly something we're thinking about. I mean, we have issued some statements previously. I can't remember that date, maybe, yeah, when we talked about liquidity and the importance of that, which is clearly a key element of what, you know, why it didn't go as it should have done for some schemes when we were seeing that volatility. So, and we have put some points about liquidity into the code as well. And that does become something that's more important to manage as well as you become a more mature scheme. So possibly, I think we want to wait for recommendations and then we'll consider if some extra guidance would be helpful.
Understandable. Okay, so we're just going to change tack just ever so slightly. We've heard some feedback from some of our members, some questions around the covenant guidance. So could you tell us more about, is there any more clarity on when the consultation on the covenant guidance is likely to be released?
Yes, so we are currently consulting internally about the timetable of when it will come out. So unfortunately, I can't share an exact date at this stage. But as soon as we do have that date, we will be going out to the market to clearly communicate that, because I know it is something that a number of people within the industry have been asking. What we did try and do when we were preparing the code was make sure that we included all the key principles and our expectations for trustees on how they assess covenant, so that they've got a strong understanding based on the code alone. But equally within the consultation responses, it would be really helpful if you can include any responses if you think we need to include more detail within that code.
Okay, great, thank you. And just keeping on that theme of some of the wider feedback we've been receiving already, could you tell us a bit about the statement of strategy? So there's been some confusion on whether or not you plan to consult separately on the content of the statement of strategy, and if so, when? So this was in the context of a template, so will there be a checklist to kind of help guide our members through it? So over to you on that.
Andrew, are you happy to pick up on that?
Yeah, yes, statement of strategy. So our plan is to consult on the contents of the statement of strategy. Haven't quite worked out the best time for that. Is probably likely to be after the code consultation is finished. But there's two elements to that consultation which I want to call out now. So there's the, you know, the contents of the strategy itself is one aspect. The other aspect is the data that we would like to get from schemes in order to assess the risk they are taking, which cuts across both the statement of strategy and things like the valuation submission. So we want to talk about both aspects because we want to look at how we can extract that data in an efficient way, you know, using the tools that are available. And apologies, I'm not an IT expert, so but you know, the tools that are available now to do that in a much more efficient way than we've done in the past. So we are planning to consult the industry and all of that.
Okay, great. Thank you, Andrew. So this question is another popular one that's been voted by the audience. So this is from Michael. I think this kind of goes back to what Katrina said earlier about making sure you have your documentation in place. But the question is, I have already seen corporate and scheme actuaries saying TPR expects a low dependency funding target with a discount rate of at most gilts plus 50 bps. So could Andrew please repeat that there is no maximum discount rate, providing you can justify the rate in light of covenant and the regs?
Yeah, I can confirm there's no maximum rate. So the fast track rate for low dependency is gilts plus 50. But when it comes to what schemes are required to do, there's no maximum rate. The discount rate should be based on their low dependency investment allocation. We think there are lots of different strategies that could be used for low dependency investment allocation. So, for example, you could have one which is very much cash flow matching using credit-based instruments, you know, things which are which provide contractual income, but more sort of, you know, unusual ones, not just high quality corporate bonds and gilts. And there, of course, you can get fluctuations, which means you can get, you know, expected prudent returns of something more than gilts first 0.5%. So that's definitely not what we're saying.
Okay, great. Thank you. So this question is from Peter. And also just to let Katrina and Andrew know, we've got about 7 minutes left to the Q&A. So just to kind of give you a gauge. So Peter, why would we not be able to assume there would be no reduction in strength of covenant after the period of reliability? Who wants to take this one? Katrina?
You want me to? I was going to say, Andrew, do you want me to start us off from that one? So I think what we're saying here is, as I said, covenant reliability, or the period of reliability, is the period in which you have reasonable certainty that the employer will have available cash to fund the scheme. Beyond that point, there is a degree of uncertainty to whether they would be able to fund the scheme going forward. That doesn't mean that the covenant's going to drop away immediately. We do appreciate that. But given that level of uncertainty, it's that period within the journey plan that we would be expecting trustees to start to de-risk. Again, it's not a sudden de-risk, it's a kind of a gradual approach. Going back to a point that Andrew had mentioned actually in relation to another point as well, it's also worth highlighting that in 3 years' time, when you come to your next valuation point, you might say actually the reliability period is still the same. It's still, as an example, 6 years. So that again would push out your journey plan that little bit further. So we're not saying that you have to start de-risking exactly 6 years after you set your first journey plan. That might be pushed out as time goes on. Andrew, I don't know if you've got anything to add, or
I think you've covered. I think you've covered it.
Okay, great. So this one is changing tack again, going back more into thinking about inflation and cash flow assets. Mr. here asking, fixed inflation linked cash flow assets are proposed in low dependency asset allocation. Sorry, I know it's a mouthful. Say it again. Fixed and inflation linked cash flow assets are proposed in low dependency asset allocations. So many bonds, securitized loans are floating rate, but produce a good level of cash flow. Can these be invested in and LDI used to just swap floating legs to fixed?
So that's quite a technical question. I think I may have to take that one away and talk to some of my investment colleagues, but I think I understand the point that there are different types of bonds and they're not necessarily fixed contractual income, but is there a mechanism for them to use ones for floating? No, I'll have to take that one away. It's a good point, something for us to think about.
Okay, we'll flag it and we can communicate, and Alistair, get in touch. We'll get you your answer. Okay, so I'm just going through here. So we're flying through quite a lot of them, which is great. Okay, so this individual's asking, does the code envisage that having reached a low dependency funding level at significant maturity, trustees can continue to set higher return? Well, trustees continue to target a higher return than the discount to seek more security, target buyout, provided that their investment strategy meets the low dependency tests. Did you get all that? Do you want me to break it down a bit more?
Yeah, no, I did, yeah. So again, there's probably two things to mention here. So firstly, we do recognise in the code there are certain circumstances in which it would make sense for trustees to adopt an investment strategy which is a little different from their low dependency investment allocation. So although we do expect in the majority of cases that the strategy will be the same, or there are some situations in which we can see you would want to adopt something different. And actually the one where you say you've got a little bit of surplus and you want to then take a bit more risk ahead to buy out is one of those situations in which we can see it would make sense to depart to some degree. There is a bigger piece here about risk taking after significant maturity, which is something that wasn't in the regulations, but DWP did highlight it in their consultation document. It's something they, looking at how could it be set up that the schemes could be allowed to take a bit more risk at and after significant maturity, whilst also meeting this low dependency requirement, and that is something they are looking at as part of the updating the regulations now.
Okay, fantastic. So we've got another 2-3 minutes that we can ask a few more questions. So I think, Katrina, this one might be for you. If the scheme is supported by third-party capital, for example, is in a capital-backed journey plan, will the capital be included in the covenant assessment? And if so, will this allow a higher level of risk to be taken in the investment strategy before and after the point of significant maturity? What do we think?
Goodness me, that again, it's quite a nuanced question, so I might have to come back a bit with an answer on that. The one thing that I would emphasize is obviously your covenant assessment should only be looking at the legal obligation. So if it has to be looking, normally when you talk about the employer, for example, they have the legal obligation to the scheme. So you wouldn't be able to recognize anything in your covenant assessment unless you have a legal obligation. But I would have to look into that more detail around the capital backed journey plan.
Okay, fantastic. So another one, trying to fire through as many more as we can. This one is a bit more straightforward. I think I might know who's asked this. Does it make sense to expect that all or even most schemes are on a path to buyout? This isn't realistic for many, is a sort of comment follow-up to that question.
So the regulations, specifically do not require schemes to head for buyout. It is just heading towards low dependence on the employer, and there's no, once you get there, there's no, it's up to the trustees, with in consultation with the employer, to decide then how run on this, the scheme. Do they want to run it off, carrying the paying benefits? And we think many schemes will want to do that. Do they want to go and push on buyout? Do they want to look at things like entering a consolidation vehicle? It's really there's no specific requirements when you get to that point about what you then need to do. We are conscious that there are actually many more schemes now who probably are in a position that might think about buyout, and there could be issues of capacity in the market, but there are clearly these different options when schemes get there, and no requirement to do particular course.
Mm-hmm. Okay, so this one is coming from the perspective of a mature scheme. How do you reflect transitional risk and liquidity risks, both which are key risks to a mature scheme? Yeah,
so we said a bit about that in the code. In terms of a transitional risk, again, this is another example, I think, where we could see that it could make sense for schemes to not invest in line with their low dependency investment allocation over a period of time, whilst they move from the investment strategy they have now to something that looks like that. So we absolutely recognise it would not be an efficient way to have a sudden switch in the investment strategy. It should be planned through and done in over a period of time, taking advantages. Liquidity, yeah, there is some comments on liquidity in the investment section. I mean, it is, as I said before, I mean, the key thing is that the more mature the scheme is, the more the scheme is paying out a lot of its assets as benefits, the more important liquidity becomes, and managing that is the key aspect of what we expect trustees to do.
Okay, fantastic. So I'm very sorry to say that we've run out of time, and I'm still going to have to start the wrap up because otherwise I'll get in trouble. So I just wanted to briefly say what our next steps are as the PLSA, and also just on the questions. If I didn't get to your question, I do apologize. Do get in touch with us. I'm sure we can try and get answers to you, and the things that we couldn't answer here, we'll try and connect Andrew and Katrina with you, essentially, so where they said that they could try and go back and speak to investment colleagues. So just to briefly say what our next steps are, the PLSA has we've just done our 2 workshops, so many thanks to you in the audience who came to help us with that. Also, there will be one more formal opportunity to feed in, where we'll be releasing a survey sometime in the next few weeks, so please keep your eyes peeled for that. Before we end, I wanted to ask Katrina and Andrew if you could tell us what your next steps are, anything that wasn't mentioned in your presentation, and to actually ask each of you to give any final reflections, either from the questions that were just asked, perhaps one key message that you'd like to leave with our members from the presentation that you gave, anything you'd like them to kind of leave this webinar with as they go on and continue reading and digesting the code. So over to you.
Well, I'll go first. I'd like to say, well, yeah, thank you very much for inviting us today. I mean, the key next step for us is the end of the consultation period. It was very pleasing to see today there was lots of very engaged questions and actually going into quite some details and really quite specific points. So I really would encourage people to respond to our consultation. It is a consultation. We are open to changing some things in the code if we haven't got it right. So please do build on what some of the thinking, what you're thinking about now, and put in a response to a consultation by the 24th of March. Is there anything else you want to add, Katrina?
No, I think I would echo exactly the same thing. Just please do provide your feedback as part of the consultation. It's really important. And also just keep an ear out for when we are going to be releasing the covenant guidance, because again, we would really welcome people's feedback on that.
Fantastic. Thank you to everyone in the audience for all your questions. And as they said, for being so engaged, we're very grateful for that. And Katrina and Andrew, thank you so much for the time that you gave for the presentation and to come speak to our members today. Thank you very much. We'll be in touch.